Imagine planting a tree today that will provide shade, fruit, and shelter for you and your loved ones in the years to come. In Canada, one of the most powerful tools to cultivate your financial future is the Registered Retirement Savings Plan that we call RRSP.
Hey everyone, welcome back to the channel. My name is Kike.
My name is Ezekiel.
And we are the
Adeleyes.
Welcome to Money CPR, where we share tips and strategies on how to win with money. In today's video, we're going to be sharing everything you need to know about the RRSP, what it is, who can open an account, contribution limit, withdrawals, and 5 facts you must know as a Canadian to build wealth with your RRSP. So whether you're a newcomer to Canada, an international student, a long-time resident, understanding the RRSP can be your gateway to building wealth and securing a comfortable retirement in this country. Let's dive in.
So guys, what is an RRSP? An RRSP is a special savings or investment account registered with Canadian government, designed to help you save for your retirement. Contributions you make are tax deductible, meaning they can reduce your taxable income for the year. Plus, the investment within your RRSP grows tax-free until you withdraw them. That's a win-win, guys. So who can open and contribute to an RRSP? To open and contribute to an RRSP, you must be a resident of Canada for tax purposes. I want you to understand that. You must have earned income here in Canada and possess a social insurance number, which is your SIN, the SIN number. This includes permanent residents and citizens. International students may also be eligible if they have filed a Canadian tax return and have earned income here in Canada. You can contribute to your RRSP until December 31st of the year you turn 71. For you to open an RRSP account, you can go to your financial institution to open one, and we also recommend a self-directed RRSP account, which is a vehicle that allows you to build and manage your own investment portfolio by buying and selling various types of investment yourself. You can do this by yourself. This is what we do. We do it by ourselves, and it's been successful. If we can do it, you can also do it.
Okay, let's talk about contribution limits. The total amount you can contribute to your RRSP each year will be limited to 18% of your previous year's income, which includes employment income, net rental income, self-employment income, and more, up to a maximum set by the CRA plus any carried forward contribution room that you may have. For 2025, the maximum amount set by the CRA is $32,490. Unused contribution room can be carried forward indefinitely, allowing flexibility in your savings plan. It is important for you to note if you have a company pension plan like we do, or any profit sharing plan, your contribution room will be reduced because of these plans. It's important to also know your contribution limit every year. And how can you know this? You can go to your Canada Revenue Agency My Account, okay? We talked about this in our TFSA video, where you can open your own CRA individual account. By opening this account, you have access to your notice of assessment after you file your taxes. If you have never opened a CRA account before, check this video description for the link. We'll put a link in this video description on how to open your own CRA individual account. This is the best way to know your RRSP contribution limit every year. And why is this so important? It's important because you don't want to exceed your RRSP contribution limit, because as always, there will be penalties. And for the RRSP, over contributions above $2,000 are subject to a 1% monthly penalty. It's important to use the CRA's tools to track your limit and avoid any surprises.
Now let's look into the benefits of an RRSP account. There are 2 great tax benefits that RRSPs provide for Canadian investors. Number 1, a tax deduction today from your RRSP contribution. And number 2, long-term tax deferred growth. long-term tax-deferred growth. With your tax deduction, you can reduce the tax you pay today, which may lead to a tax refund for you. With tax-deferred growth, investment in your RRSP can compound over time without being taxed as long as money made stays in that account. Here is the tip for you. If you always spend your tax refund, I shake my head for you. Guys, you can't afford to just spend your tax refund. Rather, it is always good to invest it. Instead of spending it, I want you to do this. Reinvest it into your RRSP or your TFSA, or other types of assets for even greater growth. Listen, if you always spend your RRSP generated tax refund, you are undermining the effectiveness of your RRSP because you are giving up your temporary government loan designed for tax-deferred growth. That's a simple fact, guys. So let's make smarter money decisions in this year 2025. You can't afford to let it go.
So now let's talk about the common uses of an RRSP. Here's the good news. Beyond retirement, RRSPs can be used for 1. The home buyers plan, allowing first-time home buyers to withdraw up to $60,000 tax-free to purchase a home. It's important to remember that certain rules apply to the home buyers plan. Check on the Canada.ca website for all the details. The bad news with the home buyers plan is that you have to pay the money you withdraw back into your RRSP over the next 15 years. The second common use of the RRSP is the lifelong learning plan, which permits tax-free withdrawals for full-time education or training for you or your spouse, not the children. And as well, certain rules apply for the lifelong learning plan.
Actually, some people forget to pay back the RRSP they take out from their account over the years. Probably after 5 years, they maybe unforeseen circumstances and all that, they forget and they stop putting it back. That can be a very big penalty from the government.
Yeah, and I'm sure the CRA will come after.
Yeah, they come after
those people.
So make sure you pay it back if you take it out. Now let's talk about tax implications and withdrawal. While contributions reduce your taxable income, withdrawals are considered taxable income, guys. It's crucial for you to plan your withdrawals strategically. If you withdraw from your RRS while working, you may face higher tax due to your current income. But in retirement, when your income is likely lower, the tax you pay on withdrawals could be significantly reduced. This is one of the key strategies to maximize your RRSP tax advantage. So you should consider the RRSP as a tax-deferred account. You are not as rich as the total amount in your RRSP account. Let that sink into your head, guys. When you take money out of your RRSP account, you have to pay tax you never paid in the first place.
Exactly. Because it's before tax dollars.
Exactly.
Right? So you didn't pay taxes before you contributed that money, right? Because once you contribute it, you get a tax refund. It reduces your taxable income. Does that make sense? So that's why it's a tax-deferred account. That's why when you take that money out, please factor in taxes. So you are not as rich as the money, as the total amount in your RRSP until it's withdrawn.
So if you withdraw up to $5,000, you are going to pay 10%. I repeat, if you withdraw up to $5,000 from your RRSP account, you are going to pay 10%. If withdrawals are between $5,000 and $15,000, the financial institution will hold back 20% of that money, of that actual money you withdraw. Another thing is that if you withdraw more than $15,000, then 30% will be withheld back from the actual money you want to withdraw from your RRSP account. It's also important to keep in mind that this won't be the only time you'll be taxed. Just make sure you keep that in mind. Now, the amount you withdraw from an RRSP will count as your income. I want you to always remember that too. It will count as your income. So you'll have to declare it once you do your tax declaration for that year you've withdrawn it. If the withdrawal ends up putting you in a higher tax bracket, you'll have to pay more income tax, since the withheld tax likely won't cover the full amount of income of tax the ones that you hold. So that's why withdrawing prematurely from your RRSP is not a great move, or should be a final last resort for you, in your decision making. You can find the income tax rate for the current year on the Canada Revenue Agency website if you're looking for one.
And also I think it's also a smart move to have an emergency fund.
Exactly.
Or a sinking fund somewhere before you start investing into your RRSP.
Yeah.
Because like my husband rightly said, you don't want to cash out on your RRSP prematurely, especially if you're still working. Like it won't even make any sense whatsoever. So if you can just, stack up cash, make sure it's liquid, of course. Liquid, make sure you have some liquid savings where you can just get into that money if you need money urgently instead of cashing out your RRSP. It's not a great move.
Yeah.
So at this point, let's look at how RRSPs can work for you. Consider Mike. Maybe Mike is a 25-year-old person, young man that started with just $1,000 in his RRSP, in a particular year. If Mike consistently invests or puts away $500 per month for the next 35 years at a 7% average rate of return for 35 years, Mike would have almost $1 million in his portfolio in his RRSP account by the age of 60 for retirement. At age 60, if Mike decides to start withdrawing $25,000 annually from his RRSP with no other significant income, guess what? Mike would fall into a lower tax bracket, and now Mike can enjoy a comfortable retirement while paying less tax.
So guys, here are 5 facts that you must know about RRSP as a Canadian. Number 1, March 3rd, 2025 is the deadline for contributing to an RRSP for the 2024 tax year. December 31st of the year you turn 71 years of age is the last day you can contribute to your own RRSP. Number 2, you don't have to wait until March every year for RRSP season to make your RRSP contribution. You don't have to wait until March to make your contribution. Some investors believe RRSP season only starts in late winter. That's not true. What's important to remember is you can make your own RRSP contribution during the year, including during the first 60 days of the new calendar year too. Number 3, an RRSP is an account. So please tell others to stop saying, I have to buy RRSPs. No, you don't have to. You buy assets inside the account to invest in.
Yep.
So stop saying that. And number 4, over to my wife.
Number 4, some Canadians shouldn't use an RRSP to invest. And you might be wondering why. An RRSP is highly effective for Canadians who will be in a lower tax bracket in their retirement years compared to their contribution years. Think of it as tax arbitrage. It could be a means to profit long term from the differences between RRSP contribution years while you're working, which you'll be taxed at higher income, versus your RRSP withdrawal years in retirement when your taxable income is much lower. So consider a younger adult just starting out. Maybe they have like an earned income of $50,000 per year. In our own opinion, it would make more sense to contribute or maximize their TFSA rather than maximizing their RRSP. But if you're an higher income earner, it would make more sense for you, first of all, still contribute to your TFSA, max out your TFSA, and then contribute to your RRSP and max it out as well, because the TFSA is a perfect account for every Canadian, regardless of your income tax bracket.
I quickly want to say that some people, they actually go by putting money into all these insurance companies, saying they are putting money in there for their retirement. I tell you, you're lying to yourself, and these guys are lying to you. If you keep putting money in there, money that you do not have any evidence of what they are investing it into or what they are doing or proof, or they are not giving you any monthly or annual statement, that means you're just wasting your money. Why don't you go ahead and put your money into your, max out your TFSA and start putting your money into your RRSP. That's the way to go, guys.
Awesome, thank you. For those earners in a lower income tax bracket who are likely to end up in a similar income bracket in retirement, the TFSA is ideal. So just in summary, okay, the TFSA is the best account for every Canadian to invest in. And it's super flexible as well. You can use it for anything, for retirement, for your kids' education, you can cash out the money to buy your first home and you don't have to repay it back. So it's such an amazing account. I can't even, say, I can't overemphasize that, right? So always prioritize your TFSA before any other account, all right? And if you're looking for a video that breaks down everything you need to know about the TFSA, we are going to link a video here, up here, and also in the video description below. Number 5, choosing between an RRSP and the TFSA to invest in honestly depends on your own situation. But our bottom line is, if you tend to spend your RRSP generated tax refund every year, then maximizing your contributions to your TFSAs probably makes the most investing sense. Remember our pro tip earlier. Instead of spending your tax refund, reinvest it into your RRSP or TFSA for even greater growth.
So guys, we have come to the end of this video, but I just want you to know that the RRSP is more than just a savings account. It's a powerful investment tool to secure your financial future and achieve your dreams. Whether you are a newcomer or a long-time resident in Canada, taking the time to understand and maximize your RRSP can set you on the path to wealth building.
And if you're serious about building a stronger financial future and a comfortable retirement, I highly recommend that you watch this next video on how to build your wealth tax-free. Click on the video to watch.